What if I told you that the greatest opportunities rarely arrive wrapped in optimism? They arrive in uncertainty. They arrive in doubt. They arrive when headlines feel heavy. When markets fall, most investors focus on price. When professionals step in, they focus on value. That difference between price and value is where fortunes are quietly built. Markets have always followed the same rhythm. Euphoria leads to excess. Excess leads to correction. Correction creates opportunity. Opportunity rewards patience. The question is never whether volatility will come. The question is, will you be prepared when it does? The transfer of wealth. There is a principle experienced investors understand deeply. Markets transfer wealth from the impatient to the patient. Impatience shows up as panic selling during downturns, chasing momentum at market highs, constantly switching strategies, reacting to every headline. Patience looks very different. Studying business fundamentals, waiting for favorable risk-reward setups, maintaining liquidity for opportunity, thinking in years, not days. The wealthy don't avoid volatility, they position for it. Studying the smart money mindset. Institutional investors manage billions, sometimes hundreds of billions in capital. But what separates them isn't access to information. It's process. Before capital is deployed, professionals analyze cash flow durability, competitive advantage, balance sheet strength, industry tailwinds, management, capital allocation, discipline. They don't ask, is this trending? They ask, will this business likely earn more 5 years from now? That shift in time horizon changes everything. Position sizing, the silent weapon. One of the most overlooked disciplines in investing is position sizing. Even if a company is exceptional, concentration beyond reason creates fragility. Professionals trim positions not because they've lost faith, but because risk must stay proportional. Let's be clear. A great business can still be a poor investment if purchased at the wrong size or at the wrong price. Wealth is not destroyed by volatility. It's destroyed by overexposure. Structural growth versus temporary excitement. There's a major difference between temporary excitement and structural transformation. Temporary excitement moves stock prices. Structural transformation moves earnings. And earnings over time move wealth. Today's structural themes include artificial intelligence infrastructure, cloud computing, cybersecurity expansion, automation, digital payments, energy transition. When companies invest billions into long-term infrastructure, they are not speculating. They are preparing, and suppliers positioned at the center of these trends often experience compounding demand. But even then, valuation matters. Great growth does not justify infinite price. Discipline always returns to risk-adjusted returns. The emotional trap of volatility. Most investors intellectually understand volatility, but emotionally they fear it. A 25% drawdown feels like failure, but volatility and permanent loss are not the same. Permanent loss occurs when debt overwhelms cash flow, competitive advantage disappears, management misallocates capital, structural demand declines. Volatility occurs when sentiment shifts, liquidity tightens, rates rise, headlines amplify fear. Professionals separate noise from damage. If earnings power remains intact, price weakness can become opportunity. If fundamentals deteriorate, discipline requires exit. No ego, no attachment, only evidence. Diversification and conviction. Some investors concentrate heavily in high conviction ideas. Others diversify broadly through index exposure, while overweighting certain sectors. Neither approach is superior by default. The real question is, can you emotionally withstand the volatility your strategy produces? Concentrated portfolios demand strong conviction and psychological resilience. Diversified portfolios require patience with slower gains. Strategy must align with temperament, because the greatest risk in investing is abandoning your system mid-cycle. Liquidity, the power of dry powder. Cash is often criticized during bull markets, but during corrections, cash becomes optionality. Optionality means the ability to buy when others cannot, the ability to average down rationally, the ability to withstand drawdowns without forced selling. Forced selling destroys wealth. Prepared capital builds it. Liquidity is not laziness. It is strategic flexibility. The role of macroeconomics, inflation, interest rates, consumer demand, credit conditions, these forces shape the market environment. Rising rates compress valuations. Falling rates expand them. But businesses with strong pricing power, recurring revenue, low leverage, durable demand tend to navigate macro cycles more effectively. Short-term macro creates waves. Strong businesses build vessels designed to survive storms. Earnings drive long-term outcomes. In the short run, markets are voting machines. In the long run, they are weighing machines. If a company compounds earnings at 15-20% annually for years, stock price tends to follow. The timeline may not be linear, but the direction often is. This is why smart investors focus less on daily charts and more on multi-year earnings trajectories. The discipline of inaction. One of the hardest skills in investing is doing nothing. When markets are noisy, action feels productive, but intelligent inaction, waiting for clarity, waiting for margin of safety, is often the wiser move. Activity is not progress. Patience is not weakness. Compounding requires time, and time requires restraint. Fear as an indicator. Extreme optimism often signals elevated risk. Extreme pessimism often signals hidden opportunity. Not always, but often enough. When sentiment collapses but business fundamentals remain strong, long-term asymmetry can appear. The key word is asymmetry. Limited downside, substantial upside, favorable probabilities. Professionals search for these setups relentlessly. The core philosophy: wealth is not built in dramatic bursts. It is built through rational decision-making, consistent allocation, controlled risk, emotional stability, long-term alignment with strong businesses. Markets will continue to fluctuate. Cycles will repeat. New narratives will emerge, but principles endure. Final perspective. Over the next months, volatility may persist. Economic data may shift expectations. Earnings may surprise. Sentiment may swing. But remember, volatility is temporary. Discipline is permanent. The investors who win long-term are not the ones who predict every move. They are the ones who stay solvent, stay rational, stay patient, because real wealth is rarely built in comfort. It is built in conviction, quietly, consistently, and without applause.